Celsius reported earnings after the market closed on Thursday, but that got completely overshadowed by an acquisition that they made. They are buying Alani Nu, which is another kind of health-related energy drink business. This is going to bring the company's market share up to a solid third position. Very possible that in the next 4 or 5 years, they could get into the number 2 position in the energy drink business. That's actually what sent the stock sharply lower after hours in trading on Thursday, and then just a few minutes later, sharply higher. So I'm going to dig into everything you need to know today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start by looking at the stock move. You can see that shares are up 33%. This is midday in trading on Friday. The big news was the earnings report, but let's get to that in just a second, because what investors are really concerned about, or excited about, I guess, would be the acquisition of Alani Nu. This is a brand that is going to kind of fit in with Celsius's products, very similar business model. So let's start with the transaction. $1.8 billion acquisition. They said that there is some tax benefits, $150 million worth of net present value of those tax benefits. So the purchase price I think we should probably look at is about $1.65 billion. How are they paying for that? There's going to be $1.3 billion worth of cash, $25 million earnout, and then $500 million of stock in Celsius Holding that is going to be restricted. So that's about a 9% pro forma ownership. The interesting thing here is that they're going to be taking out $900 million worth of debt. So you go from just a phenomenal balance sheet to a less strong balance sheet, using about $375 million worth of cash on hand and then taking out that debt. So you're going to now be a leveraged company, for better or worse. If the company grows, that could be a really good idea. But if it doesn't, you're now diluting shareholders and you're taking on more risk with more debt. So just a balance you want to keep in mind there. The other thing that I think is important is the valuation. Celsius is paying 3 times revenue for Alani Nu. Celsius's own stock trades for about 4.4 times revenue. So from that perspective, this looks like a pretty good move. Alani Nu is actually growing quicker than Celsius is as well. So that could end up being a pretty good price given the stock price. They also said this is approximately 12 times fully synergized 2024 adjusted EBITDA. What in the world does that mean? Well, there should be synergies. This is something they always talk about with acquisitions. So you would have overlap of sales staff or marketing effort, production and distribution agreements. So those are the kinds of things where it's very possible that there are some synergies. If you actually pull this out, they said that there was about $50 million of synergies expected. The unsynergized adjusted EBITDA multiple is about 19 times. So not quite as attractive, but not terrible given the fact that this is a growth company. I'll get to that, some of that in just a second. But management does expect it to be accretive to earnings per share in the first full year of ownership. That's not always what happens with these acquisitions. So that was nice to see. Well, let's go to some of the high level results, and then we can kind of look at what this acquisition may actually do to the company. Revenue in the fourth quarter down 4%. I'll get to kind of the choppiness over the past couple of years. North America was down 6%, and they actually had some nice growth in international markets. That's not a real big business yet, but look for that to be something that they can really leverage in the next few years. Gross margins really solid. I was a little bit surprised that gross margins are this high, given the fact that you had a bit more of a promotional environment. So that's going to bring down your sales revenue. But on the downside, they did lose money, a loss of $18.9 million or $25.8 million attributable to shareholders. This is a look at the revenue trends over the past few years. And this is what I think we really need to keep in mind. This was the inventory buildup in Pepsi, their biggest distributor. So that's something that actually ended up hurting the company, because you had this really bad quarter in the third quarter of 2024, probably impacted Q4 a little bit as well. But the normalized, if you just kind of average out these numbers, it still looks like the company's at least growing a little bit. Really depends on whether you're looking at year over year numbers or whether you're looking at full. It really depends on whether you're looking at Q4 numbers versus Q4 a year ago, or whether you're looking at the full year versus the full year a year ago. Let's get to some of those from an energy drink standpoint. They are looking at this. This is like marketing research, and this is their retail sales across tracked channels. So that has been growing. You can see that there's growth in 2024, but the contribution to the industry's growth is going down a little bit. And then if you look at retail dollar sales, this is data that's coming from throughout the year. That is actually coming down in the second half of the year. You also see that market share is falling in the second half of the year as well. So that's what has ultimately driven the stock lower. This was part of the destocking that we saw with Pepsi. Pepsi was seeing a ton of growth here. So they're building up that inventory. Then when you see demand start to go down, now you got to not only kind of unwind the overbuild of inventory, but maybe adjust even lower because you're expecting sales to not be quite as high as you maybe previously expected. So some of this was Red Bull getting much more aggressive with new products and with pricing. So what does management do to respond? They bought the number 4 player in this right here. So you can see that you add these two together, you get to about 15.4% of market share in 2024. Alani Nu is actually growing though, so that could grow significantly higher than that. They gave some of the details here. This is the year-over-year growth in the energy drink industry. You can see that Celsius was the one that grew the most in 2024, at least in an absolute basis. Alani Nu was number 3, so now you're combining those two companies together. Should have pretty good momentum. 50% of the overall energy drink growth. One of the reasons I ended up buying shares of Celsius is actually this right here. I think that the target audience is a much wider potential audience base, and actually Alani Nu leans into that. It's much more of a female-focused brand. So Celsius much more accessible to a wider audience than something like Red Bull or Monster. Alani Nu takes that to another level. They've also got some products that could move Celsius into kind of some new areas like snacks, shakes, pre-workout, stuff like that. So I think this is ultimately going to be a potentially really positive move for Celsius, but we need to see the Celsius brand pick up their market share a little bit and then see if there is some advantage of having these two brands together. This is something that often happens, especially in the drink and food space where, you know what, if you're distributing to thousands of stores around the country or around the world, why don't you deliver 2 products instead of delivering 1? Obviously, Celsius isn't its own distributor, but they are selling into those retailers. So that's something that they do need to think about is how is our marketing going to get leverage? How is our sales efforts going to get leverage? So this potentially leans into that, adds new product categories. So I think the acquisition is a good strategic move. The price is potentially questionable depending on what sort of growth we see over the next few years. 3 times sales isn't crazy. Like I mentioned, Celsius's own stock is trading for a higher multiple than that. So you do get a little bit of a discount by buying a private company. Is it worth the 30% premium? That's going to take a while to play out. I think Celsius has now gone from, well, the worst thing that can happen is that Pepsi would just buy them out, something I've talked about here on this channel, because they did have a solid balance sheet and a pretty solid business. Maybe not the growth business that it was a few years ago, but a solid business that could be really profitable long term. Now you move back into their balance sheet isn't nearly as strong as it was because they're taking on debt to pull off this acquisition. But now we could get back to that growth category. That could increase your multiples, increase the opportunity and the upside for investors long term. So it's going to take a little while to figure out what the exact impact on this acquisition is going to be on Celsius. I'm generally positive. I'm not selling my shares of Celsius. Going to at least give management a little bit of time to work things out and integrate the company. This deal should close in the second quarter, so we'll get more information when that actually closes and they start realizing some of those synergies. But I think generally Celsius is at least pointing in the right direction. Maybe it isn't going to be the rocket stock it was a few years ago, but could provide nice optionality for investors at this price. But let me know what you think of the acquisition and the quarter from Celsius. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.